There are a few financial ways you can do unto others while still taking care of you and yours. Jim Lineweaver is here with ways to provide for the charity of your choice and provide financially for your family. Jim is a certified financial planner professional with the Lineweaver Financial Group. Welcome back to the show.
Good morning.
So today we're talking about helping others and ourselves.
Yeah, there are some things out there where you can really benefit other people and create an income for yourself as well as possibly your beneficiaries too. So we're dealing with things that involve charity. So normally when you have a charitable entity, it could be a church or other entity that may say they've maybe helped you out through your life or whatever the reason, then you can make a donation to them. But if you structure it correctly, you can not only get a deduction, but you can also take care of your family as well.
Wow, how do we do this?
Well, one of them is called a donor-advised fund. So this is where you can make contributions to this donor-advised funds. There's relatively low minimums to open them up. Maintenance fees are very low, no annual distribution requirements, no annual tax filings, which are nice. You don't have to create another tax return. Your donations can be either publicly or private, so if you didn't want them announced out there and keep it confidential, you can. And also there's some higher deduction limits for this than some other things that we'll talk about in a little bit. But really this does give people some flexibility to say, okay, let's get started with maybe $5,000 to $10,000. It doesn't have to be hundreds of thousands or millions of dollars. And they will get a deduction for the money going in. They can get a nice income stream coming out, and they can also make it multi-generational. So if they want to not only for themselves, but possibly for their kids, they can do that. But as far as the money going to some of these charities and things, you do have to be a little bit careful.
Okay. Sounds really good, but are there disadvantages?
There is on this one, just because what ends up happening is you cannot really create you can't pay a board, so to speak. So if you're trying to get your family members involved, you can, but it's all voluntary, where some more boards they get paid. Some people, as they make donations to charities, they actually want some type of scholarship or something to go to their alma mater. You can't do that with this as well. So there are some drawbacks on donor-advised funds because you lose a little bit of the control.
Okay, well, another option, a private foundation.
Yes, this is where you're going to have a lot more money involved. So it's not just going to be the $5,000 to $10,000. It's going to be much higher than that. You get a little more flexibility with this because you can actually provide a board and actually pay the members of the board for that. And you're going to be able to have some other flexibility. If you want to do scholarships where you can't with donor-advised funds, you can name CSU or whatever university you had. You can actually get those listed for future contributions and things along that nature. So you can have a lot more flexibility, you can get more family members involved, but it's a much higher dollar amount. And with that, unfortunately, comes one of the disadvantages, or a couple of them, which is much higher costs. Okay, so maybe a starting point of this might be somewhere in the $10,000 plus. There are required annual distributions on this. They're usually around 5% or higher, where there's not any on the donor-advised funds. And there is annual reporting. So on a private foundation, you're going to have to do a tax return. It's called Form 990 or 990, and that is going to be something that's going to have to be filed on an annual basis. Okay.
But you have a third option, right?
We do, yes. This is more of the multifamily that we talked about in the beginning. So this is where if you want a charitable lead trust or charitable remainder trust, and what this means is you might be gifting a highly appreciated assets that you don't want to pay the taxes on. You can donate that to a charity, they can sell it, and then what happens is if it's a lead trust, then that charity is going to get the income first for so many years, and then what's going to happen is then after so many years, it'll kick into you and your family. But you're going to get a deduction going in, you're going to create an income, you can go multi-generational. A charitable remainder trust is just the opposite. So what's going to happen is that you're going to donate maybe these appreciated assets, get a tax deduction, then what will happen is then you're going to get the income first, charity would then get it second. But it's a nice way to benefit a lot of people involved, and you can do beneficiaries on that one too.
Lots of options. Sounds like that you need help.
There are, and so what happens is we provide a no obligation, no cost for kind of charity organization analysis if people want to try to make some donations and help their family out as well.
All right. They say charity begins at home, and that's where you can decide how to benefit others while still taking care of you and your family. For help, give Jim a call. His number's next.
For more information, call the Lineweaver Financial Group at 1-888-313-4009 or visit www.lineweaver.net.